Welcome, dear traders. You are watching a recap of the Asian session on September 27. Yesterday, Wall Street stocks saw a major sell-off. As a result, three major US indexes closed at their three-month lows. At the same time, Asia-Pacific stock markets opened with a negative sentiment on a Wednesday. In Asia's markets, risk appetite weakened amid growing fears over higher interest rates, heightened economic uncertainty, and the troubled China's real estate sector. The US economy also appears to be under pressure, with the signs of a recession yet to emerge. Recent reports on consumer confidence and new home sales have already posted declines amid the Fed's tightening policy. The WIX index, which signals the level of fear or stress in the stock market, closed at its highest level since May 2023, above 19 points. It seems that the Fed's comments are still having an impact on the markets. Although the US regulator left the interest rate unchanged at its September meeting, another rate hike is expected in the future. Several major agencies confirmed this. On a Tuesday, Minneapolis Federal Reserve Bank President Neil Kashkari said that interest rates in the United States would probably have to be raised slightly and kept at this level longer to cool down inflation. Tomorrow, Lisa Danielle Cook, a member of the Federal Reserve Board of Governors, will share her view on the situation. However, investors will likely wait for Jerome Powell's speech later on Thursday. In the meantime, the markets may prefer to trade cautiously. Notably, a hawkish outlook on the interest rates, along with the fears and concerns, provides the US dollar with a solid ground for growth. On the daily chart, the greenback surged above 106.20 against its counterparts from the G6 basket. In anticipation of Jerome Powell's speech and the new statistics on the US economy, the US dollar index consolidated in the range of 106.10 and 106.30 early Wednesday. Following the greenback, the US Treasury yields are also soaring. Thus, after the hawkish forecast of the Fed speakers, 10-year government bonds have already jumped to a 16-year high. Markets seem to disregard the threat of the US government shutting down due to a lack of funding. The shutdown could have harmed the country's credit rating. Moody's has already warned of this. However, the company believes that the shutdown will be short-lived and is unlikely to affect payments on the US government debt. As a result, the US dollar rose to a 10-month high against major currencies today, while the euro and pound sterling fell to 6-month lows. The yen was pushed deeper into the intervention territory. Yesterday, the Japanese currency dropped sharply below 148.90. Notably, its price is sensitive to changes in the long term. Treasury yields, especially 10-year treasuries, as a result, the dollar-yen pair has perked at 149.10. It's the highest level since the beginning of the year on the back of a soaring yields. In the Asian session, the pair declined to 149 within the bearish range of 148.80 and 149.20 early Wednesday. The pair showed sharp fluctuations within the trading range. The Bank of Japan's July meeting results were released today, and they showed that policymakers agreed to maintain its ultra-loose monetary policy. However, markets continue to speculate on when the Japanese regulator will end its negative interest rate policy. In other words, hawkish outlooks have appeared eventually. In addition, the yen still remains in the intervention zone. Japan's finance minister Shinichi Suzuki warned that sharp fluctuations in the exchange rate were undesirable and that the country's authorities were not ruling out any options in the event of excessive yen volatility, including the intervention in the forex market. In addition, the weak yen is putting pressure on the local economy. For example, the index of leading economic indicators released today by the Japanese Cabinet Office showed the lowest level since April. This indicator is used to gauge the economic outlook for several months ahead. Amid a slump in the manufacturing and services sectors, the index hit a 3-month low of 108.20 in July. China's real estate sector is also raising alarm. However, the country's authorities are trying to force the Chinese yuan to stay elevated. Meanwhile, industrial profits in China fell by 11.7% year-on-year in the first 8 months. With such weak data, the continued growth of the industrial sector in China is still questioned. The risks in the real estate sector threatened to escalate again. According to Bloomberg, the founder of China Evergrande Group was taken into custody in early September. The potential liquidation of China Evergrande, one of China's largest real estate developers, forced investors to avoid risky assets. And the US dollar is strengthened on the troubling news from China and the hawkish comments from Fed officials, creating roadblocks for the antipoding country currencies. The Australian dollar slid to the lower boundary of the range of 0.6371 and 0.6410 from its early Wednesday high of 0.46. Thus, the Aussie has declined for the third day and the currency failed to rise on inflation data. Australia's consumer price index exceeded the previous reading by 0.3%. In other words, the predictions are starting to come true that inflation will be spurred by soaring commodity prices. Commodity and fuel prices slowed down slightly today, limiting the Australian dollar's potential growth. Importantly, the Aussie dropped on a risk aversion in the global equity markets and Asian trading. The New Zealand dollar was trying to catch the upward wave early Wednesday, however it declined amid external factors and the stronger US dollar. As a result, the Kiwi dollar pair slumped in early Wednesday trading, consolidating within the range of 0.5923 and 0.5957, and the Kiwi closed today's Asian session lower near 0.5938. And that's all for now. Leave your comments below and don't miss our next video review. Remember that staying up to date is the key to success in your trading. See you online soon.